navigating our finances today, wow, it can feel less like smooth sailing and more like, being tossed around in a storm. There's just this absolute tidal wave of information, so much uncertainty.
Yeah.
It's incredibly easy to feel overwhelmed or even kind of paralyzed by fear.
That feeling is, yeah, it's incredibly common. Every headline seems designed to grab your attention, right? Often by just amplifying anxieties.
Totally.
Everyone has an opinion, and, well, figuring out who or what to trust in that landscape is a real challenge.
There really is. And that's precisely why we're doing this deep dive. Our mission here is to try and cut through all that noise.
Right.
To unpack these sources, articles, research notes, and pull out the really essential insights, the tools, the strategies, basically stuff that can help you become genuinely unshakable. Not just with your money, but maybe even in your overall approach to life.
And the material we're looking at is pretty comprehensive. It gives us a solid understanding of market mechanics, dives deep into the financial industry, and then what I found really fascinating is this surprisingly strong focus on what it calls the inner game.
The inner game.
Yeah, how our own psychology, impacts both our investing and just our general well-being. It's about tackling the external stuff and our internal response at the same time.
Okay, sounds good. So where do we start? It seems like the material points a finger at two main enemies of financial success.
That's where the sources kick off. Yeah, they identify the two biggest obstacles to building financial security and success as, well, fear and fees.
Fear. That feels pretty visceral, doesn't it? Something most of us have felt during those rocky market times.
Oh, definitely.
But the sources, they go beyond just the abstract feeling. They illustrate its power with some pretty striking historical examples.
They do. I mean, think about the period right after World War II. The U.S. entered this era of incredible economic growth. The stock market just took off.
Right.
Yet so many people, maybe scarred by the Depression, they were so afraid of uncertainty that they just stayed completely out of stocks. They piled into what seemed like safe bonds and then watched their buying power just get eaten away by inflation. They completely missed out on this extraordinary period of wealth creation.
So the fear of past pain actually caused them to miss a huge future opportunity. That's a tough lesson.
And it's not just ancient history. The sources talk about witnessing the sheer terror during crises, seeing people lose life savings, homes, businesses.
Yeah.
Even really wealthy, seasoned people felt vulnerable when credit markets just froze up. Fear is contagious, it can spread like a virus, just infecting millions with this feeling of complete uncertainty.
And this widespread fear, according to the material, is a major reason people just don't invest. It keeps them from becoming long-term owners in the economy.
Precisely. They stay on the sidelines, often for years, and that period of just inaction, driven by fear, that can be the single most costly decision they make over their entire lifetime.
Which, brings us to the second big foe, fees. The sources give a pretty unvarnished view of the financial industry here.
Yeah, it's described as, well, an ecosystem.
Yeah.
And while it's got lots of intelligent, well-meaning people in it,
Sure.
fundamentally it's designed to maximize profits for itself, for the companies and their shareholders, maybe not always solely for you, the client.
So even with all that brainpower in the industry, it's still easy for an individual investor to be misled.
Very easy, according to this material. It warns you can easily be fooled, even by people who seem like total straight shooters. It talks about fiduciaries, those folks legally required to act in your best interest, but then it immediately cautions about wolves in sheep's clothing. People who might claim that status, but are still pushing products that mostly benefit them.
Okay, so let's break down how these fees usually show up.
Yeah.
The sources talk about different kinds of investment funds, right?
Right. They mention hedge funds, first private, usually for high net worth folks, known for high fees, complex strategies.
Okay.
Then you have mutual funds. Public, actively managed. That means you've got professional managers constantly buying and selling, trying to pick winners, time the market, beat an index.
And that active management, it sounds impressive, but the sources hit us with a statistic about mutual funds that's, well, it's pretty jarring.
It is. One study they highlight shows that a stunning 96%, 96, of actively managed mutual funds fail to beat their benchmark index over 15 years.
96%. So you're paying way higher fees, often for the managers to actually underperform the market. You could have just tracked easily yourself.
That's exactly the point the sources are making. They call it overpay for underperformance. It's like, paying Ferrari prices and getting the performance of a basic tractor. The costs are high, the results, often not so much.
So what's the alternative presented?
The third type discussed is index funds, Also public, but passively managed. Instead of trying to beat an index like the S&P 500, they just aim to replicate its performance, hold all the stocks in it.
Yeah.
And because they don't trade much, need way less research staff, their costs, including those fees, are dramatically lower.
And the long-term impact of those fees, even if they seem small year to year, that's shown really clearly with that Joe and David example.
Yeah, that comparison is critical. It makes the abstract impact of fees really concrete. So you have Joe and David, both start with $100,000, both earn the same average 8% return over 30 years.
Okay, same starting point, same return.
The only difference is the fee. Joe pays 1% a year, David pays 2%.
Just one single percentage point difference. Seems tiny.
Yes. But look at the outcome. After 30 years, Joe, paying 1%, ends up with around $865,000. David, paying 2%, only has about $548,000.
Wow, that's...
That seemingly small 1% fee difference means Joe has over $317,000 more for retirement. That's like a 58% bigger nest egg.
And it doesn't just affect the total amount, right? The sources show it impacts how long the money actually lasts in retirement.
Dramatically. If they both start taking out, say, $60,000 a year in retirement, David's money runs out by age 79.
Oh, wow.
Joe, with his bigger balance, he can take out $80,000 a year, a third more, and his money lasts until he's 88.
That completely changes your quality of life, your security.
Absolutely. All because of that seemingly small fee difference, compounded over decades.
That really drives home the importance of controlling what you can control. And fees are definitely in that bucket. The sources also had that cynical Dogbert comic, didn't they?
Yeah, where the CEO's bragging about starting 10 random mutual funds, then just hyping the one that did well purely by chance, claiming it's proof of their imaginary expertise.
Right.
It's satire, obviously, but it reinforces the source's point that sometimes active management success is just luck or clever marketing.
Okay, so we've seen how fear keeps people out, and fees can really eat away at returns if you're not watching them. But another huge source of anxiety is just market volatility itself. So it swings up and down. The sources acknowledge that feeling, especially, when markets been going up for a while, people start fearing a big crash is coming.
That fear of the next crash is very real, absolutely. But the material offers a pretty powerful antidote here. Understanding the market's own history, its nature. It lays out several freedom facts, they call them, that give crucial perspective.
Okay, freedom facts. Let's look at those. What does fact 1 tell us about market drops?
Fact 1 is basically that corrections defined as a drop of 10% or more from a recent high, they happen on average about once a year since 1900.
Once a year.
Yeah.
Okay, that perspective really changes things. They're not some rare catastrophic event then.
Not at all. The sources emphasize their normal recurring events, like seasons changing, winter comes,
Yeah.
And they point out how financial media often just sensationalizes this volatility for ratings, all the turmoil and mayhem.
Okay, breaking news graphics.
Exactly, because fear grabs eyeballs, right? Even if the underlying causes are often unclear or debated by the very experts they have on screen.
Yeah, you see the drama, hear the urgent tone, and it makes you feel like you have to do something right now.
And that whole media narrative often feeds this idea that someone, somewhere, knows exactly what the market's going to do next. But, well, as the physicist Niels Bohr famously said, prediction is very difficult, especially about the future.
True. So trying to time the market based on these predictions, jumping in and out.
The sources are pretty blunt about it. They describe trying to consistently time the market as delusional.
Delusional.
Yeah.
Strong word.
Yeah. Consistently predicting the tops and bottoms. Simply not possible, according to this material, not for any of us.
But okay, despite these regular drops, the overall trend of the market is upward over the long haul. That's fact 4, right?
Correct. Freedom Fact 4 points out that while the S&P 500, for example, has had an average drop of 14.2% within any given year, looking back over decades,
Okay.
the market still finished with a positive return in about 75% of those years.
3 out of 4 years end up positive, despite those scary intra-year drops.
Exactly. It's like, yeah, winter makes its appearance, but spring reliably follows, and the overall trend is growth.
So the short-term turbulence is normal, expected even, but the underlying long-term direction is up.
Precisely. And that long-term rise isn't magic. It's driven by real economic stuff. Companies getting more profitable, increased productivity, population growth, new technology. These forces push stock prices higher over time.
And if there's a big dip, a bear market, the sources actually frame it not as a disaster, but an opportunity.
Yes, very much so. They echo Warren Buffett's thinking. Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price.
Like a sale on stocks.
Exactly. A market plunge means shares in great companies are available at a discount.
That definitely requires a different mindset than the fear we talked about earlier, doesn't it?
It requires focusing on opportunity, not just the danger. Which leads into fact 7, and this is a really crucial takeaway. The sources emphasize that the greatest danger to your financial health isn't actually a market crash itself.
Okay.
It's being out of the market, missing the recovery that follows, missing the long-term compounding growth.
That's where the Jack Bogle quote fits. Don't do something, just stand there.
It sounds totally counterintuitive when fear is screaming at you, but the data backs it up. The material shows this chart comparing different investment approaches from like 1993 to 2012. The investor who just stayed in cash the whole time ended up with just over $51,000.
And then there was Mr. Hapless, the guy with unbelievably bad timing, always investing right before a market peak.
Even him, even with that spectacular, consistent bad luck over 2 decades, Mr. Hapless still ended up with a substantial profit. Why? Because he just stayed invested. He let compounding work its magic.
So being in the market through thick and thin is what builds wealth, not trying to perfectly time the ins and outs.
That's the message. Staying invested is key.
Okay, so if staying invested is critical, how do we invest strategically for the long term? The sources lay out some core principles.
Yeah, the first one highlighted is pretty fundamental. Do not lose. This is core for legends like Buffett, Bogle, Ray Dalio. Their primary focus is on protecting the downside first, minimizing risk.
And the sources suggest making this a requirement when you're vetting advisors. Ask them how they protect the downside before they even talk about potential returns.
Absolutely. Make it the first filter. The second principle is something called asymmetric risk-reward.
Asymmetric risk-reward.
Okay. This kind of counters the common idea that you have to take huge risks to get big rewards. The best investors, according to this material, look for situations where the potential upside is vastly, vastly greater than the potential downside. You risk a little to potentially make a lot.
Like that Carl Icahn example. He always seemed like such a high-risk guy.
On the surface, yeah, his moves looked really risky. But I can explain that while the appearance was high risk, the underlying math, the calculated risk, was actually quite low compared to the potential reward. He understood the numbers in a way others didn't. He said, math doesn't lie, looking beyond perception to the actual probabilities.
So it's about intelligent risk assessment, not just going with your gut. What else is crucial for strategy?
Diversification. Presented as just foundational for long-term success. It's basically admitting you don't have a crystal ball. You can't know for sure which specific investment or sector or country will do best. So you spread your bets.
Like the dodos in the comic, don't put all your eggs in one basket.
Exactly. And the sources emphasize diversifying in a few ways. Within asset classes, don't just own one tech stock. Own many across different industries. Diversifying across markets, countries, currencies, because, hey, it's a global economy.
Right.
And diversifying across time, using dollar cost averaging.
Could you quickly explain dollar cost averaging again, how the sources present it?
Sure. The material explains it as investing a fixed amount of money on a regular schedule, say every month, regardless of whether the market is up or down.
Okay, automatic investing.
Yeah. So you automatically buy more shares when prices are low and fewer shares when prices are high. It takes the emotion out of it, stops you from trying to time things perfectly.
And the sources gave that powerful example of diversification really paying off during the so-called lost decade of the 2000s.
Yeah, that period, 2000-2009, the S&P 500 index was basically flat. Super frustrating for a lot of U.S. stock investors. But the material shows that a diversified portfolio, one holding U.S. stocks, foreign stocks, emerging markets, bonds, real estate, would have turned $100,000 into almost $192,000 during that same decade.
Wow. While the main U.S. index went nowhere.
Exactly. About a 6.7% average annual return. Diversification helps smooth out the ride and catches growth from different places when one area is struggling.
And finally, the last big strategic point the sources hammer home is tax efficiency.
This is critical and so often overlooked. Frequent trading, like you see in actively managed funds, often generates short-term capital gains.
And those are taxed at higher rates, right?
Much higher. Your ordinary income tax rate. This can just decimate your actual take-home return. The sources have this example where an 8% gross return could shrink down to a tiny 1% real return after you account for fees, taxes, and inflation.
1%. You'd never retire.
They joke you might retire at 120 at that rate, whereas long-term capital gains, holding investments for over a year, Those are taxed at a much lower rate.
Significantly lower.
Typically, 20% is the max federal rate mentioned. So the key takeaway is max out your tax-advantaged accounts first. Your 401ks, 403bs, IRAs. Use those tools to shield your returns from taxes year after year. That's crucial for letting compounding really work.
Okay, so implementing these strategies, protecting downside, asymmetric risk-reward, diversification, tax efficiency, it sounds like a lot. It might lead someone to think, okay, I need professional help. But the sources are pretty frank about the challenges of finding a truly trustworthy advisor.
Yeah, that's a major hurdle the material tackles head on. The industry just has inherent conflicts of interest. Advisors might be pushed to sell their own company's funds or charge hidden fees or get these disguised consulting fees for recommending certain products, things that benefit the advisor or the firm more than you.
And the sources even give some pretty concerning stats about legal settlements paid by big financial firms.
They do. The material notes that between 2009 and 2015, just 10 of the largest financial firms paid out almost $180 billion in legal settlements.
Billion with a B.
Billion with a B. 4 of the biggest banks alone accounted for nearly $146 billion across 88 settlements.
You'd think that would deter bad behavior, but the sources suggest maybe not always.
The perspective offered is that for companies making billions in profit every few months, even these huge fines can sometimes be seen as just a routine cost of doing business, like a parking ticket almost, not necessarily a reason to fundamentally change how they operate.
Oof. Okay, so given that landscape, how do the sources recommend you actually find a good guide, someone you can trust?
The big emphasis is on finding a true independent fiduciary. And the material makes this important distinction. It's not just about someone who can act as a fiduciary sometimes, but someone who operates as a high-sophistication fiduciary across all aspects of your planning. They show this quadrant diagram, you want the top right corner, high fiduciary standard and high skill sophistication.
Got it. So what are the concrete things to look for? Vetting criteria.
First, check credentials. They suggest looking for a certified financial planner, a CFP, maybe having attorneys and CPAs on the advisor's team, depending on how complex your situation is.
Okay.
Second, and this is really crucial, make sure they use a third-party custodian, like a Fidelity, a Schwab, a TD Ameritrade, to actually hold your money.
Why is that third-party custodian so important?
The sources highlight this as protection against Madoff-style fraud. The advisor never directly controls or holds your assets.
Oh, okay. Makes sense.
It also makes it super easy to switch advisors if you're unhappy. Your money stays put at the custodian, you just change who manages it. Third, the advisor needs to show how they bring tax efficiency tools into all aspects of your financial picture, not just the investments piece.
It sounds like finding this kind of world-class advisor is maybe tough, but the sources call the outcome a huge prize.
Yeah, the material really suggests the right partnership can be incredibly valuable. A great advisor helps you nail down your goals, builds a solid strategy, keeps you disciplined when things get rocky, and just significantly increases your odds of actually hitting your long-term financial targets.
Now, we've focused a lot on investing, markets, advisors, but the sources make a pretty significant pivot here. They argue that being truly unshakable isn't just about the money.
Or this is where that inner game section really comes in. The sources make this powerful point that real wealth is multifaceted. It includes emotional, psychological, spiritual well-being, getting financially free but still feeling miserable inside. It's not really a win, is it? It's kind of a hollow victory.
They even mention running into extremely wealthy people who are just profoundly unhappy.
Yes, reinforcing that point that money itself doesn't automatically create happiness or fulfillment. Chasing money, thinking it's some magic bullet for happiness, is called a delusional belief in the material.
And the story of Robin Williams is used as a really powerful, though obviously extreme, example of this.
It is, immense global fame, fortune, bringing joy to millions. Yet he publicly struggled so much with addiction, depression, illness.
Yeah.
The sources note he made everyone happy except himself, which just underscores that external success can't compensate for internal suffering. It really drives home the point that if you're not fulfilled, you have nothing.
And the material draws that crucial parallel, like on an airplane.
Yeah.
You have to help yourself first.
Exactly. The oxygen mask analogy.
Yeah.
Secure your own mask before trying to help others. You have to cultivate your own inner state first to really enjoy life, handle challenges, and actually be able to help others effectively.
And the sources go pretty deep into how we can take control of that inner state. They suggest most suffering isn't caused by external events per se, but by our own undirected mind focusing on 3 specific patterns.
Yeah, these patterns seem to be triggered by our basic survival mechanisms. The first is focusing on loss. The belief, real or just perceived, that you've lost or will lose something valuable. Love, respect, health, money.
Financial security, yeah.
Exactly. The second pattern is less, constantly comparing yourself to others or some ideal and feeling like you have less, you are less, you're not enough. And the third is never believing you'll never get something you want or you'll never get over something painful that happened.
And the sources really emphasize that the key point here is it almost doesn't matter if the perceived problem is objectively real or not.
That's the core insight. Whatever we focus on, we feel regardless of what actually happened. Your internal experience is largely shaped by where you put your focus. And so often the suffering is deeply self-focused, right? Revolving around my losses, my deficiencies, what I'll never have.
Okay, so if focus creates suffering, what's the antidote the sources offer? How do we shift that?
By consciously choosing appreciation and gratitude, the material presents this as the single most powerful tool for changing your internal state.
It sounds almost too simple, gratitude. But what does the research actually say about its effect?
Well, the sources quote Sir John Templeton, quote, "To overcome fear, the best thing is to be overwhelmingly grateful." The act of consciously shifting your focus to what you appreciate, what you're grateful for, it actively slows down that survival mechanism's grip.
Interesting.
It creates space for a different perspective. And over time, doing this consistently can literally help rewire your nervous system to naturally seek out the good.
Because you can't really feel genuine gratitude and intense anger or fear or worry at the exact same time.
They occupy different emotional spaces, yeah.
Yeah.
Cultivating gratitude isn't about pretending problems don't exist. It's about choosing where you direct your mental energy most of the time.
Right.
The sources describe living in a state of appreciation as a choice. The choice to live in a beautiful state instead of a suffering state. And making that choice consistently is called the greatest prize. It leads to genuine enjoyment of life. They even suggest a simple 2-minute gratitude meditation as a practical tool to start doing this.
Okay, bringing this back around to investing. It's pretty clear our psychological state massively impacts our financial decisions. The sources talk about specific mental traps or biases investors fall into.
Yes, the cognitive biases, overconfidence is a huge one. The material cites studies showing most people believe they're above average drivers, teachers, even more honest than average, often totally contrary to reality.
Right.
Yeah.
And how does diversification, which we talked about earlier, act as a defense against that overconfidence bias?
Well, diversification, as presented here, is kind of a direct counter to overconfidence. Because when you diversify, you're essentially admitting you don't know for certain what's going to perform best.
It's humility built in.
Exactly. You're not betting everything on your own brilliant prediction. You're humbly spreading the risk, acknowledging you might be wrong.
Another big bias mentioned is confirmation bias.
Oh, yeah. That's our tendency to actively seek out information that confirms what we already believe and just instinctively dismiss or ignore anything that contradicts our views. The sources point to media echo chambers really amplifying this, just feeding people stuff that validates their existing opinions.
So how do the really successful investors, according to the sources, fight against this confirmation bias?
By actively, deliberately seeking out qualified dissenting opinions. They don't just hang out with people who agree with them. They look for smart, credible people who see things differently and force themselves to consider, okay, where could I be wrong here?
Like the Buffett and Munger example.
Exactly. Warren Buffett, constantly consulting with Charlie Munger. Munger was famous for his sharp mind and his willingness to tell Buffett when he thought he was wrong, sometimes even changing Buffett's mind on big things.
So instead of looking for validation, you should actively look for potential flaws in your own thinking.
Precisely. The sources strongly recommend asking trusted friends or advisors questions like, where could I be wrong here? What am I missing? What's the downside I'm not seeing? It's a proactive way to fight that bias.
And finally, the sources caution against a certain type of information, the kind designed specifically to make you take action.
Yeah, this loops back to the financial media and a lot of Wall Street research. Their business model often depends on generating activity trades, calls, appointments, because that's how they get paid.
Right.
So the sources argue this information isn't really designed to give you wisdom, it's designed to make you do something, often impulsively. The strong advice is minimize your exposure. Avoid financial TV. Ignore most Wall Street research. Check your portfolio way less often, maybe just once a year. Basically, turn off the noise that encourages you to react emotionally.
Wow. We have covered a tremendous amount in this deep dive. Really, from understanding those external forces impacting our finances, fear, fees, the market itself, finding good advisors,
Right.
all the way to exploring this crucial internal game, managing our own state, countering those cognitive biases.
And becoming truly unshakable, based on all this material, it isn't about somehow eliminating all risk or never feeling uncertain again. That's not realistic. It's about equipping yourself with proven financial strategies, things that work over time, while simultaneously cultivating that inner resilience, that inner peace that comes from choosing appreciation, consciously directing your focus, recognizing how much your internal state shapes your whole experience of life, including your financial journey.
So it's really about building a strong foundation, both externally with the practical stuff and internally with the mindset, building that strength to navigate whatever comes your way.
Exactly. True, unshakable wealth, as these sources define it, seems to be that powerful combination. Real financial security coupled with genuine inner fulfillment.
Okay, so to leave you with something to think about from this deep dive, what is one small, concrete action you could take today? Maybe it's a financial step. Maybe it's a shift in your psychological approach based on what we've explored here that could move you just a little bit closer to your vision of true unshakable wealth.